All right, so today on the webinar, we are going to be talking about, like you can see on the screen there, the importance of understanding cap rates in apartment syndication. So we're going to be going through what you see on the screen there. What is a cap rate and how is it calculated? We're going to do some whiteboard stuff with you here, virtual whiteboard stuff. So I don't have an actual whiteboard behind me or anything, but we're going to be doing some on the screen here. And then also, should you be buying in a high or a low cap rate market and why? So make sure you stay tuned to that part because it's going to probably, open your mind a little bit to how you actually view cap rates in a market. And of course, what are blue chip corporations and why are they significant to cap rates? And then also we're going to talk a little bit about the power of the cap rate. And really, we're going to probably touch on the power of the cap rate more in the calculation of actually how the cap rate is actually calculated. So without further ado, let's go ahead and dive into this webinar today. And for those of you who this is your first time being here on the webinar, I wanted to talk to you a little bit about myself. So I'm Dan Handford, one of the managing partners of a group called PassiveInvesting.com. You can see the website here. If you want to find out more information about our group, just go to PassiveInvesting.com. I'll go ahead and click this link here and type it into the chat box for those of you who are joining us live. So you can certainly go there. If you're interested in joining us in some of our future opportunities, you can click on this blue button on the top right-hand corner of the screen, and that's how you join the Passive Investing Club. You can fill out the form there. And then my assistant will reach out to you. We'll have a one-on-one conversation, just you and I. She'll schedule you on my calendar. We'll see if our group is a good fit for you. We'll talk about your investment goals, and then we'll go from there. So if you want more information about myself, my background, you can click on the Meet the Team. You can see our team members here, and then you can also click on my name here, Dan Handford. There's a video right here, so you can kind of figure out a little bit more about me and myself, and also my background. So my family, I also talk about in there. Also typed into the chat box for those of you who want to do that. So one thing that I wanted to point out, I am married. I do have 4 children, three girls and a boy. So they're all under 10. I got a 9, 8, 3, and 2. So life is definitely busy in the Handford home. And we live and work here in Columbia, South Carolina. Unfortunately, we don't invest here in Columbia, South Carolina, and you'll find out why throughout the webinar today, because we talk about these various the various power of the cap rate, if you will. There's reasons that cap rates are moved, and it's one of the reasons why we don't invest here in Columbia. So let's go ahead and dive right in. And we're going to talk first about what is a cap rate. So let's first talk about that part of it. So the cap rate is short for the capitalization rate, right? And that capitalization rate is basically telling you if I was to pay for this property 100% cash, how much would my annual return on my investment be? So to give you a quick example, if the property is $1 million property, right? It's a $1 million property, and it's in a 5% cap rate market. Well, the easiest way to figure that out is you take the $1 million, you multiply it by the 5%, and that's going to give you that $50,000 return on your investment. So that's what they call the capitalization rate. Now, the cap rate is not always indicative of the actual return on an investment when you start to use leverage. What I mean by that is when you start to get a loan on the property, start to use debt, then that's when the return starts to go up because you're actually using leverage for a portion of it and you're not bringing all equity to the table. That's why debt is actually a good thing with these types of investments because it allows you to have a lower cost of your capital in your capital stack, right? We've talked about capital stacks in the past. I even wrote an article in one of our recent investor newsletters on the actual capital stack and what it is and how it's structured and what's the importance of it and where you really want to be in a capital stack based on your investment goals. And so I'm not going to go into that in a lot of detail, but if you want to go to our YouTube channel, you can type into that search box on our YouTube channel for capital stack. And we actually did a webinar on the capital stack as well and went into great detail about that as well. So before I move forward, I know a few people were saying they were having some issues with my screen, but hopefully you guys can see my screen now. If you want to just give me a thumbs up, raise your hand, whatever, let me know everything is looking good here. All right, cool, great, awesome. So everybody's raising their hand there, making sure we're all good. So I'm gonna go ahead and dismiss this one thing on here in the Q&A. So thank you for bringing it up to my attention. I think what happened earlier on is I didn't press the play button on my sharing, and so it wasn't sharing it just yet. So hopefully you can see that now. We're going to be talking about the importance of understanding the cap rates here. So let's talk about how it's calculated, how the actual information is calculated real quick. So I know I kind of verbalized it a little bit just there, and I might have gone a little bit too fast. So I'm going to share my screen with the whiteboard. And yes, Maurice is asking, will a recording of this be sent out? Yes, it will be. So if you register for the webinar, it'll be sent out to you. We'll also post it on the YouTube channel for you to watch later as well. So if you have to drop off early, that's not a problem. Or if you're going through this, like he went really, really fast, because I do usually talk fast, and you want to watch it again, you can certainly do that as well. So let's open up this whiteboard here for just a moment. And I want to share this with you just so that we can have a better understanding of this piece. So first off, let's kind of take this down a different direction here. I'm going to just move some things around on my screen so I can see things okay. All right, so we're talking about this cap rate, right? And again, as most of you have followed me, I'm not the best artist, but at least you get to see the visualization of some form or fashion. So we're talking about the cap rate or the capitalization rate. And so if we have, let's just for ease of use, I'll just say a $1 million property. You have this $1 million property, and it's in a 5% cap rate market. So we're going to say $1 million times 5%, which if you convert that to a decimal, it's going to be 0.05, right? So that's the 5%. So we're just going to call this 5% here, okay? And that's going to equal your 50,000, right? That's going to equal 50,000. We'll just make it short there. So $1 million property times the cap rate equals your return on your investment if you were to pay 100% of that property with cash, okay? Now, the cap rates in a market are changed and are shifted up or down or compressed or expanded based on the demand in that market. And so when you understand how the cap rate actually has changed based on the demand, it'll help you understand why we go after a certain type of cap rate. So the higher the demand of a property in a market, the higher the demand is in a market, not necessarily just that asset, but the higher the demand of that in that particular market is going to cause the cap rates to be compressed, which means they're going to start to go down, right? So I'll give you a quick example. 3 or 4 years ago, you could have bought in Charlotte, North Carolina, a middle of the road B-class property for probably around 5.5% to 6%, right? Right now, the demand in that Charlotte, North Carolina market is actually going up, right? And it's continuing to go up. So I've seen some deals right now being traded at 4.4% cap rate in that middle of the road B-class product, where normally you don't usually see some of those lower end cap rates until you start to get into the A-class properties. When you get into the A-class properties, there's usually a lot more demand because there's a lot more institutional equity available there. And so those cap rates do start to get driven down, right? And so the opposite of that also occurs when you're talking about cap rates that are in markets that have lower demand. So if you have a lower in secondary or tertiary market that you're looking for an asset in, you're going to see that those cap rates are going to be a lot higher than a higher end market, if you will, or a more stable market. And it's because most investors are not looking for just to get the highest return. They're looking for a risk-adjusted return, and you usually see that in a more stabilized market. What we've been seeing lately over the last several years is a lot of investors have started to move out of the inner core investments inside of stabilized markets because they're chasing those higher yields. In order to chase higher yields, you have to go farther away from an actual primary market so that you can start to get the returns that they used to receive years before that, right? And the problem with that is that the reason why you have to go out is because the cap rates are going down, and now the demand is going out. And so even right now, we're starting to see the market, we're kind of on the middle of COVID-19. The market for multifamily is still pretty strong. And we had a little bit of a lull there earlier this year for probably 2 or 3 months while we're trying to figure things out. But once we've actually figured things out and things have been stabilized and it wasn't, the end of the world, if you will, when it came to, multifamily investing. Now, it's not the same for some other asset classes, but specifically for multifamily, we see that the demand is now still there for acquisitions, right? And that demand is with even pre-COVID has caused a lot of people to go out into some of these lower end secondary and tertiary markets. So what has that done? That has caused the cap rates in those markets to actually be compressed as well, more than what they used to be, where they might have been like a 10, 11, or 12% cap rate market. They're now going down to like 6, 7, and 8% markets. And it's because the demand in those markets are going up. Well, think about it. You have to look at it on the opposite way too, is when you have some sort of a downturn or correction in the market, which markets are going to be affected the most? They're going to be those tertiary and secondary markets that are going to be affected the most. And those cap rates, because investors will stay away from those markets. If you try to sell a property during that time, those cap rates are going to go way up, right? And what I mean by way up, if you're buying something right now in those markets at 7 or 8%, they're going to probably go up by about 200 to 300 basis points, maybe even 400 or 500, right? Depending on the market and depending on the type of demand in that particular market as well. Whereas when you look at a market that has higher demand in a hot market right now, if for some reason the market shifts or changes or turns, you are going to see some expansion in those cap rates. However, it's not going to be as dramatic as you would in those higher cap rate markets. You're going to see that those cap rates are going to maybe go up by maybe 50 to 100, maybe 150 basis spreads in those markets. And there are going to be some markets that might be more than that. Some markets might be less than that, right? But you're going to see kind of on the average, if you will, between about 100 to 150 basis spread on those cap rates. Except for if you find a market that you actually have if you find a market that actually is stabilized, that actually has this is kind of going to the next topic of what we were talking about. What I brought up was blue chip corporations, right? So a blue chip corporation is a corporation that is usually well known and is publicly traded. And those publicly traded, well-known corporations are what creates stability in a market, which is why so many markets are on a feeding frenzy, if you will, of trying to give tax credits and give tax incentives and things like that to these various large corporations to come into their market, because they know, those cities know it creates stability in their markets. And if they have the more stability that they have in that market is going to cause the cap rates to go down. The property values are going to go up because they're going to be trading properties at a higher rate and at a higher amount. And guess what that does for the city? Higher taxes across the board. So that's why cities try to do that with those tax incentives, is because they know that they're going to get that, not just from the property taxes, but obviously it's going to provide more jobs and it's going to cause more demand in that market. So there's going to be new housing. There's going to be new GDP in that market. There's going to be a lot of different things that are happening in that market when new corporations come in. But the thing that we really like to see is obviously new jobs coming into the market, but we also like to see those stabilized jobs in the market as well. And so this is, if from all the information that I've told you so far, for those of you who are on here, here watching us live, I want you to type into the chat box and tell me, would you prefer to buy in a high cap rate or a low cap rate market, given what I just said? So just say, put higher, low inside the chat box. Let me just kind of see where you're thinking right now. And that way I can maybe help you and expand your mind just a little bit on what I've said so far, because everybody's a little bit different. And even after I explain things to you today, you still might not agree with me, but I'm going to show you the power of the cap rate after I explain to you what we're talking about. So I got most of you on here are saying low. A few of you on here are saying high. The majority of you are saying low. Some of you are saying different things. Like, I know Mike's on here. He says, if you're chasing capital gains, then high, right? Depends on projected growth rate, median to upside, there are definitely some things that, depending on your game plan, you might want to choose something differently. But I would contend with you that, in my opinion, it is always better to go after a low cap rate asset. And a couple of reasons why. Some of them I've already mentioned to you about having a more stable market and things like that. But even if you are, because the person that usually argues with me or discusses or debates me with this the most is somebody that would say that I only buy in high cap rate markets because I'm a long-term buy and hold investor. Okay. Well, if you do your analysis on a 5-year hold projection, which is what you would normally see, usually 3 to 5, maybe 5 to 7 year holds on these multifamily investments, you will, if you do an analysis in a, say, 8% cap rate market versus a 5% cap rate market, and then buying long term in that 8% cap rate market for 20, 30 years, and you do the same analysis, but rolling that 5% cap rate into an investment and rolling it into the next investment every 5 years, growing that principal and growing the amount of money that you're actually making off of that, you will see that at the end of the day, you will make more money in a low cap rate market than you will in a high cap rate market. It takes a little bit more work because you're having to trade that thing every 5 years or so, 5 to 7 years, but you will make more money with that. So the argument that you're just a buy and hold investor and you make more money that way is not true. If you do the analysis, you will see you will make more in a low cap rate market, no matter what kind of way you look at it, right? But obviously, there's a lot more work and trying to make more money with that. Now, if you're the type of person that's like, you know what, I don't really care about making the most money. I just want to make a nice, decent return, and I'm going to buy this higher cap rate market, just hold on to it forever. Fine, that's fine. And some people think that once you do a refinance, you get your money back, all of your money back, and now it's an infinite return. It's not really true, because now you still have equity built up in that investment, and you have to analyze that investment like that. If you were to sell that investment, take the equity and put it into another investment, you could actually continue to grow that even more. Excuse me. Had a little hair in my throat there. Sorry. All right. So that's kind of my explanation from a couple of different reasons, but let me go into it from a little bit further detail with you. Okay. So on the screen now, you should still see this little cap rate thing here. And what I want to discuss with you is I think I might have shown this before on a different webinar, but one of the things that I like to look at it is also the value of my time, energy, and effort in an asset. And so if I go after, let's just say we have a middle of the road Class B property that we're looking at, right? And we're gonna compare two different properties. So let me see if I can clear. Here we go. Clear all my drawings. All right, I'm gonna start from scratch here. So we're gonna say there is this. Nope, that was a bad one. I'm just going to say this just because it's a triangle. I'm going to call that multifamily property A, right? This will be A, and then B, right? This is just like trying to label them. It's not saying the asset class. The asset class on both of these, we're going to say, is a B class property. So middle of the road B class property is what we're talking about here. Okay, so this is the middle of the road B class property, and let me just dismiss a few things in here. Okay. The middle of the road B class property have asset A and asset B. Now, this asset A is actually in a stable market, right? We're going to call it a primary stable market. Okay. So we have this primary stable market, and then we have this we're going to call this a secondary to maybe tertiary market, right? And we're just going to say it's less stable. So, because stability of those kind of markets is just dependent upon, jobs. And like I said, these blue chip corporations in the market, and most blue chip corporations aren't going to go to a second or tertiary market. They're usually going to stay inside of a primary market, mostly because of the tax incentives, right? But also because the pool of jobs is also higher and greater in a primary market. So we have these two markets. We're all set up now. And this particular market is going to be a 5% cap rate market, right? Because there's more demand. So it's more stable. So more investors are there. So that because of that demand, that cap rate is now compressed down to that 5%. And we're just going to say that this one, we'll just be a little bit more conservative with this, instead of saying maybe like 10, 11, 12%, which is what you normally or could normally see in certain markets that are in those tertiary and secondaries. We'll just say 8%. So on the lower end, but let's just do a quick analysis here. Well, let's say that we are doing the same type of renovations and things like that. And honestly, let's just say we were able to increase the rents the same, right? Same renovation, increase the rents the same. And so we affected the NOI. We increased the NOI on both of these assets. We increased the NOI, that's the net operating income, by $100,000. Okay. So we're in it for $100,000 increase over the life of the hold. Now we're ready to sell these assets. Okay. Now let's do the same calculation as we did before. We've increased that NOI by 100,000. So now I got to figure out how much value increase did we have on this property? Well, over here, if we take that $100,000 investment, not investment, the $100,000, if we take the $100,000 increase in the NOI, right? If we take that $100,000 increase in the NOI and we divide it by that 5% cap rate, what is that going to equal, right? That's the question we have to ask is what's that going to equal, right? And so this is going to equal $2 million, right? So you can just do the math over there if you'd like in your head, or you can do it over on a calculator. I'm a human calculator, so I don't need to. No, I just know these numbers. So $100,000 investment. We're gonna do this again, 100K. And you divide that by the 0.08. What's this going to be, right? This was not supposed to be a smiley face. It was supposed to be an arrow, but they ended up being two smiley faces. So they should be arrows. But all right, let's see here. So this is actually going to be 1.25 million. It's going to be a 1.25 million on that 8% cap rate market, right? So look at the value differential between these two investments. So now we have a $2 million increase in value or a $1.25 million increase in value. I spent the same amount of time. I spent the same amount of energy. I spent the same amount of effort, but it's two different markets, right? So now you can also see the power of the cap rate, right? And why you would want to go after maybe these lower end cap rates versus the higher end cap rates. Because even if you went to those higher end cap rate markets, it's less stable, but you're going to also have a harder time selling those at the end because you're going to have to probably change that cap rate to attract more people. And that's why those cap rates are the way they are. So if you start to buy at a 5% cap, let's say you are a buy and hold investor, right? I challenge you to do that calculation to say, I'm going to buy in a 5% cap rate market, right? And then I'm going to hold it for 5 years and sell it in that market, right? And then roll it into the next investment. So now you're taking your initial investment plus the equity you gain on top of it from the sale, and you rolled it into the next investment every 5 years for 20 years versus just holding on to this 8% cap rate market for 20 years. Guaranteed, your 5%, you're the lower end cap rate market will be much better. Okay. So I'm going to open up for some questions here. I covered all these different, all the topics that I wanted to cover today on the power of the cap rate. So I want to open it up for questions. So I know there's already a bunch of questions already coming in here. So I'm going to open up these in just a moment. So let me see. All right. So before I asked with the high-low, there was a question in there. What do you think of PPMs and prospectus summaries that assume lower cap rate at acquisition and higher cap rates at sale? Well, I think that, Eric, whenever you're doing your underwriting, you should certainly stress test your underwriting to sell in a higher cap rate environment, right? So that's just being conservative with an exit assumption. Now, the opposite is also kind of a concern, is like if you have somebody who's entering at a certain cap rate and they're projecting to sell at a lower cap rate, depending on the business plan. So it is still possible to do that, right? But you typically don't want to see that in your underwriting. That's not as conservative. What our group does is we always try to underwrite and do sensitivities based on an expansion or an increase in the cap rate when we sell, because the chances of that happening are fairly slim, but we still want to do a sensitivity to test that. And we also look at it and say, what's going to be the returns on this investment if we can sell at the same entry point of our cap rate right now, right? And so that's actually a good thing to look at, is look at it at the same time. All right. If it's I'll give you a quick, kind of tip there as far as the underwriting is if it's an asset where you are holding it for, and it's like a lower end C class or a middle of the road B class property, you're going to probably want to see at least a 10 basis point increase in that exit assumption on that cap rate for every year that you're into it, right? So if it's a 5-year hold, and there needs to be a 50 basis point expansion on that sensitivity. If there's going to be a 7-year hold, it needs to be a 70 basis. If you're going into some of the newer products like the Class A's and the higher end B's and things like that, you don't normally need to see that much. I don't usually like to see, I don't like to see it. I do like to see it, but you don't necessarily have to see that, because the chances of those higher end properties, expanding that much over that period of time is not as great. I still want to see an expansion, but it doesn't necessarily have to be a 10 basis spread for every single year. On your most recent deal, so I can't talk about any of our recent deals, Irish. So Irish Kevin. So if you have any questions for me on that, you can email me directly. This is not the place for that. Let's see. Going down to do some of these questions. So let's see. Somebody said on here when we were talking about buying a high cap rate, selling a low cap. So that would be great to be able to do that, but you're also, that's one of the highest risk investments to do. So if you really like a very high risk investment and probably a lot of work, then you could try to do that. But you're basically betting on buying in a high cap rate market, probably a kind of middle of the road second or a higher end secondary market. And you're hoping that more jobs are going to come in to create more demand in that market. And so yes, that would be great. But that's kind of like the unicorn, if you will, that's very hard to find. Let's see. Okay, so Courtney's asking, what do you mean by more work? There's more work to fix up the facility or increasing rents? Yes, that is correct. So usually you're going to have a lot more work that you're going to have to do to be able to get it up to a point to be able to compress that cap rate. To what extent should we assess the likelihood of cap rates rising? So I did already answer that question, Clive, a little bit earlier about just a minute ago when I was talking about the high and the low. Markets in Canada. So Joe's over there in Canada. 5% is a higher cap rate. Hence, I said higher on my response. Depends on location. So yes, that is correct. So you start to look into markets like Southern California. There's going to be probably sub-3 caps, maybe even sub-2s in some markets, right? So it is definitely market specific as far as where these different cap rates are. So when I'm talking about, I'm talking about kind of like the Southeast, Midwest, those kind of markets that, you'll typically see that kind of spread of 5 to 8 upwards to like 10 or 11 or 12% in some of those, lower and tertiary markets. Let's see here. How do we find out the current cap rate of a particular property? So that's a good question. So there's a couple of things that you have to look at. And so it's not necessarily looking at the current cap rate of that property. It's the current cap rate in the market, right, for that type of property. And so the best way to find that out is to go and look at the most recent sales that are in the area. We use a software called CoStar, which allows us to have a lot of that data at hand. But you can also look a lot of this data up online on your own in some of the county databases. And another way you can find out this information is to call some of the local multifamily brokers in the area and ask them, hey, I'm looking at this B class or C class or A class property. What's kind of the market kind of going cap rate for where this particular property is located, right? And they can usually give you that input and give you that data. Now, with all that said, it doesn't always mean that you should only buy that property in that particular cap rate, right? Because different properties are going to demand different cap rates based on what the seller's demands are. Now, if a property is in typically a 5% cap rate market and that seller is trying to get a 3.5% cap rate on it, there better be a pretty good story as to why they're getting a 3.5% cap rate on it, because you're not going to get a lot of buyers at that cap rate if you're normally trading that market at 5%, right? So there also has to be the story behind the property. And so usually those multifamily brokers will help set the expectations for those sellers to know what's the typical cap rate their property is going to trade at. And that's what they give them in the beginning before they go out with their properties, what's called a BOV, a broker opinion of value. So TK is asking me, he's here in Columbia. He said, you mentioned that you were going to briefly discuss why you don't invest in the Columbia market. So I thought it was pretty obvious, but for those of you who don't know a lot about the Columbia market, there's not a lot of blue chip corporations here. There's a few local corporations like Blue Cross Blue Shield and things like that, but there's a lot of state and government and military here. So there's a lot of transient people here, and there's also University of South Carolina. So for me, I have to look at a market as a whole and go, does that market have a lot of blue chip corporations that can create a lot of stability? And this market just doesn't have enough. There are a few, but there's just not enough for me to be able to bring in my investors into this market. And I live here, right? I would love to invest here if I felt like it would be a good thing for my investors, because I want to make sure that I can bring investors into an asset that is going to be there for the long term. And I know a few people who have been passive in some investments in Colombia. I have not myself. We don't put together any properties this way either. And they have not gone so well. Now, is that the norm? I don't know. It's a kind of a select few, right? And I'm probably hearing from people that, are upset about that investment, right? But I choose not to invest in Colombia, even though it would be easy for me, because I just don't feel like it's the right thing for my investors. And so I primarily invest in the Carolinas, and it's usually Charlotte, North Carolina, that whole MSA, and the Raleigh, Durham, Chapel Hill kind of triangle area, Charleston, South Carolina, and Greenville, South Carolina. And it's because they're all four of those markets are laden with blue chip corporations. All right. So Gregory's asking, all things being equal, what about other factors? For example, in California, you have rent control, tenant rights, etc. So yes, so I definitely look at it and balance it with the other types of things that are in the market. So just because California has a 2% cap rate market or 3%, I'm not just going to go after it because I want the lower cap rates, because there's also other risks involved when it comes to Southern California or just California as a whole. So usually the West Coast and the Northeast is where we stay away from. Not just our group, but also my own personal investments that I have myself. I stay away from those markets, and it's because of what you just mentioned there about the rent control and the tenant rights and not being as landlord friendly. We prefer to be in more landlord friendly states. All right. Is there such thing as a standard cap rate for quick analysis? Not really. Usually when you're trying to buy an asset, you're going to usually get a kind of back of the napkin number or a whisper price, or you're going to get some guidance, if you will, on what the per door target is for a particular acquisition. And that's going to really give you that ability to do a quick analysis as to whether or not that deal is going to make sense for you, is asking that broker, hey, where is this seller kind of headspace wise? Where are they trying to get? And let me see if I can even get there, because if you can't even get there, there's no point in even going further to try to tour the property or anything like that, right? So you want to try to do that quick analysis if you can. Percentage for things like expenses, to give you an idea of what it could be, like 2% of purchase price or something for real estate taxes. I don't have those numbers here in front of me, Erickson, but if you go to our YouTube channel and you type in underwriting or expenses, I think it's actually just underwriting. Danny, our underwriter on our team, actually came on and did a series of webinars on underwriting. He also did a live underwriting in front of everybody a couple months ago. So if you want to go there and look for some of the videos where Danny was on there, that would be very big. That would be a very big help for you. Is there a free website that consolidates cap rates for different markets and how it has changed over the years, like historic data? So I don't know of any free websites that do that, but obviously the website that the software that we use called CoStar does have some of those historical data, some of that historical data on it. You can also contact some multifamily brokers and ask them for prior issues of their quarterly reports, because they usually will issue like CBRE, Marcus and Millichap, Cushman and Wakefield. They'll issue these quarterly multifamily market reports that will usually list some of the major markets. It doesn't go into all the submarkets, and it doesn't go into all of the like secondary and tertiary markets, usually just the primary markets, but it does give you that historical data. But you could pretty much call any multifamily broker in a market and say, hey, what's been the trend over the last 10 years, right? In that particular market. I could probably tell you right now, their answer is going to be it's been compressing, right? Because since 2008, since it was about 2011, 12 is when they really started to compress again. They've been compressing ever since. How much importance do you give to flood and hurricane risk in a market? So it does come up, Ben, because obviously right now it's important, because in the particular market, you can't, right now it's important, right? Because there's a hurricane coming through right through St. Charles, Lake Charles, Louisiana, right? So I actually have a group that I was supposed to have a call with earlier today, and they had to postpone it to later in the day because they're actually taking a lot of calls from their investors because they have some properties in Lake Charles, Louisiana. So Thankfully, on our assets and everyone else's assets, the lenders are going to require you to have a ample insurance, and even on top, you have insurance on top of insurance, on top of insurance, right, to cover you for events just like that, including loss of income, right? And so there are some things there that also are there to help you and protect you from that downside, and that's what you pay that insurance for. Now, usually in those markets, you're going to pay a lot higher for the insurance because of that particular risk. So usually it's the insurance that's going to go up because of that. That's all baked into the cap rate, because that insurance is going to decrease the NOI on a property, and that's what you're going to base that cap rate off of, is what's the net operating income of that particular property. Let's see here. How do you calculate 100 basis points? Is that the same as 1%? So the answer to your question is yes, that is correct. So every 0.1 or a tenth is going to be 10 basis points. So somebody says a 50 basis point spread is a 0.5% increase. If it's a 100 basis point increase, it's going to be 1%. What is the best way to find out the cap rate for a specific market? Already answered that. How can a 5% cap rate be better over the years, say 20 versus a 9% cap rate? So I would not necessarily say that if all you did was held a 5% versus a 9%, that's not what I'm saying. I'm saying if you take that 5% cap rate and you actually sold the asset in 5 years and then reinvested that money, and that you're going to be reinvesting the equity in the deal plus your initial investment. So in the equity, when I say the equity, you're going to be reinvesting the equity, which will include your initial investment plus your upside gain on that property during that 5-year hold, right? And so if you take that and now reinvest that and buy a larger property every 5 years, because you're going to have more money to spend, then you're going to have a higher return versus just sitting on a 9% cap rate market for a long period of time. Let's see. Once interest rates go up, it will start affecting the numbers, and that in turn will affect the cap rate. Yes, that is correct. So because the interest rates are really low right now, the cap rates have not really compressed that much. They've compressed maybe a tiny bit, but they've really just been stable is really what they've been. And so what could happen, or what will likely happen is as those interest rates start to rise, the cap rates will also start to rise, right? But you would have to have a really significant increase in interest rates to have a major shift in those cap rates. So yes, you are correct that there is some difference between that, because if I can get debt cheaper, then I can spend more money on the property. And so the competition on that property is going to drive that cap rate down and compress it even more. So that's definitely a very good point. All right. Well, that's all the questions for today. I want to thank each one of you for being here. Let me see if I have this thing to refresh. Oh, there we go. So next week, we're going to be talking about this, explaining equity waterfall structures in apartment syndication. So this is another topic that we're going to be talking about. So let me see if I can type in here into the chat box. So if you want to register for that, you can. So there it is into the chat box for those of you who are watching us live. We're going to be talking about this topic right here, explaining equity waterfall structures in apartment syndication. It's going to be next Thursday at 12 p.m. Eastern. We're talking about what are equity waterfalls, what are the 3 most common types of equity waterfall structures, and then which equity waterfall should you use in your next deal as you are putting things together. So thank you guys so much for being here. This has been a great webinar. I really enjoy the interaction. I really appreciate all the questions, and we'll look forward to seeing you back next week for another episode of the Multifamily Investor Nation webinar series.